Hi, everybody. It's Jessica Stone at Stansberry Research, and I'm joined by Enrique Abeyta of Empire Financial Research. Enrique, we're hearing so many people right now talk about the dot-com bubble, making comparisons, saying it's 1999 all over again. Listen, you are someone who lived through 1999 on Wall Street. I figured you'd be a good person to ask. What are the comparisons? What is similar in your view?
So, in 97, we were in an environment where there was a economic crisis in Asia that kind of spread as a little bit of economic contagion throughout the world, began to hit emerging markets. And that really culminated in late 1998, where there was a very famous, at the time, hedge fund called Long-Term Capital Management. These were the wizards of Wall Street, John Merriweather, who had been the head of the Salomon Brothers trading desk. Just this crazy thing, 2 Nobel Prize winners. They were running 30 times levered. They were crushing it for like 3-4 years. Everyone thought they were infallible, but they had way too much leverage and they left themselves vulnerable. And so we basically entered into what now would be called a flash crash back in late 98. The Fed gathered a group of banks and injected a great deal of liquidity into the economy, because their view was that the contagion that would happen from long-term capital could perhaps take down the whole financial system. So that worked. The market went down, which in today's terms is a couple days trading, but went down, 15% in just about a month or so. And then it came right back. But the next step, because of Y2K, at the time there was a very large concern that all the computers were going to stop because of this bug of coding, the Fed kept the liquidity spigots on. And what happened is that coincided with 2 other things that were happening, both of which are legitimate, but sort of had unintended consequences. The first of these is that, we were at an incredible period in technology. Netscape had gone public in 94, Yahoo in 96 or 97, Amazon in 97. We were just on the cusp of the emergence of some incredibly disruptive technology, but it was so early stage that a lot of these companies were just ideas. It was really hard to make them material or to make them substantial. So what happened is the friction in trading began to go down. So for
people could do it on their own, basically, or a lot more easily.
Yeah, a lot easier. And you could do it with, $5,000, and you didn't have to jump 30 hoops, and it could all get done in, 10 minutes or whatever. So what happened is we took a very real technological advancement stage, combined it with, a drop in the friction or an increase in the ease of trading, and threw a whole bunch of, Federal Reserve, kerosene on top of it. Boom, next thing you know, from the time the Globe.com went public, November 13th, 1998, for the top market, I want to say the NASDAQ, I know through year-end 99, it was up 120%. So let's segue to today. You'll notice there's a lot of similarities. We are, again, in the midst of numerous technological advances. Combine that, though, with take the amount of liquidity the Fed injected 20 plus years ago. We just injected 100-fold. Now I'm being pithy. Honestly, it's probably about 47-fold.
It's a perfect storm between technological revolution, ease of trading, and extra liquidity.
And now the ease of trading is the one that's the biggest factor. So while I think a lot of people hearken to the Fed, I think that they're really underestimating what's happening with ease of trading. Now you can trade $5 lots of stock online like you're trading a video game. You can be a 12-year-old kid doing it, and you can watch the other traders see what they're doing and what's trending. I mean, mind blown. I think that we're setting up a really, really explosive cocktail. Everyone points to the crash.
Right.
Back in April of 2000.
We don't really talk about the ride up. So given that we may well be on the ride up right now, how do you suggest people trade this market?
Well, I suggest, and sorry to talk my own book, you get some really good advice.
Where could we get that, Enrique?
Yeah, exactly. I'm in a pretty unique spot. I was an active hedge fund manager, beginning in 96, 97. I was active throughout all this period. I made money in the melt up. 99 was one of my best years, maybe my best year ever. I made money in the melt down. 2000 was a solid positive year.
So it is possible. You just
So
have
it
to
is
know
possible.
it's
Yes.
coming.
Yeah, well, and I think it's a combination of discipline. I wrote this in a letter this week, actually, a combination of opportunism and discipline. You know, you have to know what kind of opportunities to take advantage of in this kind of environment, because not all opportunities are going to be the same. And then you need to be ruthlessly disciplined in terms of how you manage your trading and or investing. And the best advice I have for all of that is find a great person who's done this before and can, give you some guidance on it.
Thanks so much, Enrique Abeyta, joining us there. And if you would like to see much more content just like that, please subscribe to our YouTube channel. You can also find us on Twitter, Facebook, and Instagram. That's all for now. Thanks for watching.